Easiest way to build a portfolio of fully managed rental homes in the US.
A Canadian coming in, like how would they likely finance that?
High level aspect that kind of goes into selecting where we invest is, the business friendly environment of, that state and that market.
Most people have not used an asset manager in my audience, but you're
Mhm.
not the property manager, you're the asset manager acting as the owner. So all those headaches that normally get passed up to the owner, you guys intercept that. So that's pretty cool. I want you to analyze a new market, one that you've never analyzed before. I want you to pick it. What's the first thing you're going to look for? Welcome back to REI Hot Seat. I've got Dmitri Bourchtein on today. He is from Share, a company that does asset management in the US, and I think you serve a lot of Canadians. Your colleague Andrew was on my podcast. We went through a deal. We talked about what he was up to, and I wanted to have you on to dig into the data analysis. What goes into picking a market? Because so many Canadians right now are thinking about investing in the US. So, Dmitri, first off, thank you for doing this.
Yeah, thank you for having me, Andrew. It's a pleasure.
Well, I'm looking forward to hearing what you have to say. Because I really love having people on who dig into data and how to pick markets. What are the hacks? What are the shortcuts that you can use to help find a market that's got metrics that are promising for the future? So do you want to give me just like a quick high level what you do, and then we can get into some of the details?
Yeah, high level on kind of Share first, and then kind of what I
Yep.
do.
Yeah, please do, for people who aren't familiar with Share.
Yeah, perfect. So, what Share is, we're the easiest way to build a portfolio of fully managed rental homes in the US. It's in essence a model of, institutional quality asset management for retail investors that are looking to, retain direct ownership, full upside and control of their investments, but want to do it in a passive way. So, us as Share as the asset manager, we in essence streamline everything from the end-to-end process, from sourcing through to helping get to closing, and then taking over as, acting as the owner on behalf of our clients. So myself, I appreciate kind of the introduction. I'm one of the co-founders, and I kind of oversee anything and everything to do with the real estate side of the business. When it comes to both, as you mentioned, deciding where we want to invest with our clients, figuring out their buy box, and then kind of executing and, sourcing and managing those homes on their behalf. So that's a little bit of a kind of a brief intro. A little bit about myself. I was previously with a large Canadian private equity real estate investment shop. I was, solely focused on the U.S. residential market. It's a large Canadian landlord with a sizable U.S. division. And I kind of got to, see rapid growth there and really witness kind of the diversification from just being in Texas when I joined to, investing in over 15 markets and building up a portfolio of close to 20,000 units over almost a decade there.
Okay. And so are you Canadian?
Yeah, I'm Canadian.
Yeah, living in Canada now?
Yeah, but I live in Toronto.
Okay. And as far as like, do you do any investing on your own, or is it strictly what you're building with a company?
So I've done some real estate investment in the past. A lot more was kind of passive in terms of, investing in various funds or REITs. And I'm definitely looking to get into the single family space myself over the coming year.
Nice. And one thing I'll point out is different about you guys, which I found interesting, is most people have not used an asset manager in my audience, but you're not the property manager, you're the asset manager acting as the owner. So all those headaches that normally get passed up to the owner, you guys intercept that. So that's pretty cool.
Yeah.
But it's not like they're just investing in a REIT or in a fund. They actually still get to own that property. And if it appreciates 20% over the next 5 years, they get to realize that benefit. So
Exactly.
I just wanted to draw that distinction. It's generally not something I've heard a lot about from guests on the podcast or on REI Hot Seat, which we don't do a lot of guests on REI Hot Seat. But just because we were going to jam pack this one with analytics and approach, I thought this would be a great episode. So give me an idea how you pick the markets you do. And just to preface that, I know that you guys are in Tennessee, I think in Memphis. I think you're in Atlanta, Georgia with your portfolio. tell me some of the other places, and then we'll get
Yeah.
into how you picked them.
Yeah. So you're right. We're definitely kind of in Tennessee, in Memphis, Chattanooga. We've looked for clients kind of elsewhere in Tennessee, including Nashville. And currently in our portfolio, we are in Georgia, we are in Texas, and actively looking at a number of various markets and states. Really kind of depending on what that individual buy box our client has. What kind of profile of deal they're looking for, what kind of returns and yields they're targeting. And that really helps us kind of drive their investment thesis into, specific regions and specific markets. And I guess, to start off in terms of how we go about selecting it, I think, first and foremost, you want to understand which markets are landlord friendly, right? I think that's very big, especially as we have, as we talk about, helping foreign clients, such as our Canadian clients, invest in the US. I think you're very well versed in the fact that, that's something that if someone's looking to get away from investing in Ontario per se, they're very focused on making sure they're getting into markets that have, favorable regulations for landlords.
For sure.
The other kind of high level aspect that kind of goes into selecting where we invest is the business friendly environment of that state and that market. Again, that's very closely correlated with corporate relocations, job growth, and obviously in-migration from people from less affordable states, kind of relocating to those types of places. So I think on the first level, we are very focused on what we would call kind of whether it's Sun Belt or Smile States, Midwest, with our clients, because again, those regulatory frameworks are very key for us deciding where we want to invest.
Well, let's dig into that a little bit more, though, because, I mean, you say landlord friendly. That was sort of your starting point. And then we're definitely going to get into immigration, job growth. That's the stuff. That's the gravy right there. But starting with landlord friendly, like in my mind, pretty well any state, maybe Hawaii exempted, and I'm not familiar with Hawaii, but any state would be better than Ontario. Is that true or not true?
Yeah, I mean, I think that's probably true. I mean, I would say, there's definitely states in the US that have, similar type of laws when it comes to, rent control, evictions, etc., as Ontario. Maybe it's a bit better, but there are definitely still high regulatory states in the US, and
Yeah.
I
Can
don't
you
want to
think of an
necessarily
example
correlate.
of that?
Yeah, like I would say California and New York are definitely much closer to what you see in
Mhm.
Ontario, especially kind of in certain counties, in
Or
certain
like the
kind
city,
of,
yeah.
yeah,
Because I know like rural New York State,
yeah,
like that's a fair playground. Like people don't mind.
exactly.
Yeah.
Yeah, exactly. So
But
again,
New York City,
it's
you
not
would not want to be an investor in New York City coming from Ontario.
exactly. And
Yeah.
similar, to California. Now, some states might, be somewhere in between. You do have states that have rent control in the US, but it's much more favorable. So obviously someone from Ontario that's like, hey, there's rent control here. You can increase rents by 7% plus CPI on renewals. That's not bad. If you're getting if you can push rents up to 10% a
Right.
year,
Yeah.
it's not necessarily, the rent control as it means to Ontarians. But again,
Mhm.
those things do come into play, and we're definitely kind of actively looking at that.
But even like there's even some blue states, which I mean, I guess like maybe they call South Carolina a purple state,
Yeah.
but it's typically a Democrat run. Is that something that you would consider? I mean, those
Yeah.
are beautiful states. Like I feel like there's tons of opportunity there. I know a lot of investors go there.
Yeah, yeah, no, we're definitely looking both kind of in North Carolina and in South. Again, I think there's various factors that kind of come into play on top of just the first two we talked about, which
Mhm.
are regulatory frameworks. But yeah, I mean, I think there's great opportunity in both those states. I mean, on top of South Carolina, which you mentioned, North Carolina, Raleigh, Charlotte are two very strong markets with great quality of life that have seen, growth over last number of years, and in large part because people want to live there. There's great employment. And, something like Raleigh, it's also populated with very good universities. So there is incentives for families to relocate there and grow up kind of in that market and get access to some of these great universities.
Okay, I like you brought that up. So that's one of the factors you're looking for universities that bring people into the town.
Yeah, that's definitely one of the factors.
Are any other key indicators? Like I'd love to get some benchmarks or things that you look for as a starting point. You want to see in migration of a certain amount, or you want to see job growth outpacing population growth, or I don't know. You give me what it is.
I think those are fair. I mean, obviously, numbers, change, and we're always kind of actively looking at the latest source of data. But you're right. One thing we're very focused on is population growth. And with something like population growth, you can even kind of get a little bit more granular with some data points on, household growth, right? Because at the end of the day, you want to see households growing, more demand for living, residential living, whether that's, people buying homes, or whether that's people looking to rent single family homes, or even, the quasi kind of correlated market, which is apartments. Right. So looking at household formations relative, especially to, supply, right? Ultimately, supply and demand both kind of play a key role in us deciding, and also like how the market will perform over time, and trying to get into areas where, there is, favorable long-term pressures for growth when it comes to demand for housing. So yeah, looking at really at household formations, and looking at kind of job growth that might correlate. So
household formations, that's just basically tracking a grouping of people who want to live together. And
exactly.
That number itself can be tracked against new houses, or we
can track that against supply, and just kind of get better sense of which metros, which areas have been seeing kind of stronger drivers when it comes to that.
So if I were to tell you right now, I want you to analyze a new market, one that you've never analyzed before, I want you to pick it. What's the first thing you're going to look for when you pull up that new market?
Yeah, I mean, first I'll want to get the understanding of the regulatory framework there, right? I think that's key. Again, really will depend on the size of the market, right? Like, are we talking about a major metro? Are we talking about, a smaller market, et cetera? There's going to be different levels of data available. Right.
So say it's like 500,000 people. It's like a city of 500,000 people.
Yeah. So, I mean, obviously, first thing we'd look at is, understand the regulatory framework in that state, and in that city. Then we would definitely kind of start looking through, the census available data, population growth, job growth, et cetera, kind of understanding which of those drivers are positive there, and looking at kind of what the level of information is available. We definitely kind of dive into the metrics of what are rents there, what are house values there, what has been the trend over the past number of years. Definitely screen for major employers and what is really driving the sector of employment there. What kind of industries, any major corporations.
Yeah. Is there a minimum number of like in terms of diversity of employers that you're looking for?
I don't know if there's like kind of a minimal number threshold for certain things, but we're definitely focused on, what are the jobs, blue collar, white collar, what are the salary levels, and especially kind of when it comes to growth, what's driving any relocations that may be happening, right?
So you want a place that's growing, like you want a place where the population's been consistently growing, or will you look at a market where it's been declining?
Yeah, so I mean, I think generally we definitely want to focus on areas that are growing, areas that kind of have positive drivers when it comes to some of the factors I just mentioned. Yeah. Having said that, if there's an opportunity in a market that may be declining, there's obviously the element of numbers, right?
If the numbers are high enough,
what is the risk return, right? If you're getting a better rent relative to like rent to price ratio. And you see kind of some good metrics when it comes to general occupancy, etc., and rental demand, for instance. You can compensate some of that risk
Hmm.
if you're getting a premium on yield and returns.
I've sort of done that, and it was a mistake for me the way I did it, but I invested in Youngstown, Ohio, and I was getting like a 16, 17 cap. But
Mhm.
I mean, just part of it was how I managed them, but the properties literally by the time I paid closing costs, like I sold it for far less than I had acquired it for. Like, no one really knew prior to like the last couple of years what it's like to have properties go down in value. But that
Mhm.
happened to me.
Yeah, and look,
So
like
it can
we're
be
cognizant
frustrating.
of that, but
Yeah.
if you're getting very strong yields and you're a long term investor, then you're looking at what am I getting back from that
Hmm.
initial equity I put back. So if you're holding it
Yeah,
for a long period of time, there are different types of investors, right? There are ones looking for cash flow and they're willing to, you know, over the long term take maybe less appreciation.
hmm,
Um, or there are ones that, want call it safer type of investment. They want to be in kind of the really hot institutional
hmm,
type markets, and are willing to sacrifice some initial yield and let that grow over time as the
for
conditions
sure.
improve.
What's like some go-to tools that you'll use to look up the population data, job growth data, just so people can start to get an idea, some of the viewers of this show, if they want to look it up for themselves?
Yeah. So I mean, census, U.S. Census data is definitely very, is where I point people to kind of start off, right? I think that kind of gives you the real-time information in terms of population, jobs, etc. We do have access to some, institutional type third-party research as well. We also kind of have a network of colleagues, both between Andrew and Carmen, my co-founders, and myself, people that are in the space. It's always good to kind of get, real-time information and guidance from people. I think, less accessible to maybe some of the listeners and viewers, but one other area that we really kind of derive a lot of data from is our third-party managers. So, as you kind of mentioned at the start of our conversation, we're set up as the asset manager. We're not the boots on the ground. We use third parties and have master agreements at discounted rates with
Hmm.
institutional type kind of property managers, large sophisticated shops that basically have share as their client, and we
Yeah.
handle everything that has to do with the individual owner. And the benefit, and I've seen that kind of historically in my career as well. The benefit of working with those types of shops is you know they have proprietary data, right? They're in the
So they
market.
see what's
They
happening
see
real
what's
time.
happening, right?
Yeah. Yeah.
They have agents on the ground, whether they're doing, sales and purchases or leasing. They'll have other
Yeah.
owners that every month, they are, sending out renewals. They're
Yeah. They're
doing
seeing
they're
turnovers and all
they're,
that
they're seeing
stuff.
turnover. They're seeing what's happening in
Yeah.
cost. They have, their
Yeah.
network of providers there. So, a lot of the time, I'll have those discussions with, our portfolio managers and everything at those companies being like, what has happened over the last two
Yeah.
months, right?
So they could
Because
tell you there's two new companies that are announced and coming into town, and like they'll know that stuff.
exactly,
Yeah.
exactly. They're kind of at the forefront of that local knowledge, and
Hmm.
that's part of the challenge, right? I think people invest in their, around where they live because they kind of
Yeah.
have that that local knowledge, and it's hard, right? Like when we're doing remote, I can't spread myself into local knowledge everywhere,
Yeah.
right?
That's
I'm
hard.
not going to be boots on the ground everywhere at the same time. It's impossible. And obviously, we want to have the network of partners set up that
Hmm.
allow us to extract that same level of information.
But
So I think that,
at the same time, you would have like high level, obviously, knowledge. You know your
of
states.
course, of
You
course,
know the big metropolitan areas and sort of what their breakdown is, and then it's more specific if you're getting into
exactly,
suburbs and you're getting into smaller stuff.
exactly, right?
Yeah.
So you can look at kind of the major macro
Yeah.
and understand kind of the thesis and
Yeah.
where you want to go based on the metrics we were just talking about. And a lot of that will be driven by
Yeah.
census, will be driven by third-party publications, etc. But then it's getting into the micro of certain locations and also
Yeah.
getting ahead of certain trends, right? Some of the stuff you will be able to see through data that's released by third parties, by census. But there's always a bit of a lag when it comes to that, right?
Yeah.
Things that are published are always going to take a little bit of time to filter through into publications, etc. Versus again, managers
Yeah.
will
The
know
real time,
what
you
the
really get
feed,
it.
yeah,
Yeah.
what the feedback has been, where
Hmm.
the occupancy is on their portfolio, etc.
Okay. So if you had to pick today, like say you had to invest in something before the end of 2024 for yourself personally, which
Mhm.
city are you going to pick and why?
Yeah, so I think for me, that's always it's always an interesting question. I think, for myself, one market I'm definitely kind of focused on, and would probably be where I would start myself would really be Austin, Texas. I generally like Texas, as a market, and again, you can kind of there's never major metros. There's also some tertiary parts, which I think can be strong investments. I think I'd lean towards Austin, um, given the profile of the city. There is a strong demand from professionals in many industries to kind of live there. We've seen a lot of kind of corporate relocations there. And I've really kind of seen the city grow, and that's kind of correlated with both appreciation and rent growth. Now, one thing to kind of caveat is you're always looking at some of those drivers relative to supply, right? So
Hmm.
a market like Austin has, it leads the charts on, a number of different, data points, whether, they're top in employment growth, they have really strong median household incomes there, etc. But, they also do have, supply and supply and a strong supply outlook, right? So
Meaning
you
they
do
can
want to kind of
bring,
be
so they have like housing starts that are in line with their
y-
population growth.
yeah, yeah.
But wouldn't you
So
prefer it less? Like I'd want to go to the market where job growth and population growth are outpacing that.
yes. So I think there's it's kind of twofold. For sure, that's definitely something I'm cognizant of. And now you look at certain markets, you look at certain pockets of Austin, and you also kind of look at future outlook, right? So, current supply starts obviously will influence where the market is, or something under construction will influence, the short term of, if there's more supply that comes on, maybe your rent growth is going to be a bit slower. Maybe
Hmm.
your, appreciation is going to be slower. But I'd want to invest for a long term. And we work with clients that are investing with long-term horizons. So, it's also very important to kind of factor that in because, you're getting announcements for, factories of semiconductor chips being built. And, that's starting construction is going to take a few years. Then there's a ton
Right.
of jobs that come in. So, you are also trying to kind of look at the forward outlook. But
Yeah.
again, I think the other part that really draws me to Austin is, you know, climate. It's warm. People have relocated there. It's, central. It's accessible.
Yeah.
So,
And
a lot of those.
politically attractive to a lot of people, right? Like that's like why did Joe
Exactly.
Rogan relocate there, right? Like
Yeah.
why did
Why
so many
did
people like
Elon
it's
Musk
trendy.
like,
It's trendy
yeah.
now.
And
And part of that actually concerns me in that if you didn't have a long-term horizon, you know that the market's already built that into the pricing. Like those announcements, those changes are already built into that pricing. It already reflects that. So you really do, if you want to invest there, have to be thinking 10 to 20 years
of
and
course,
knowing
of
that that
course.
trend continues, values continue to go up most likely, and then most
Yeah.
importantly, do you have cash flow there?
Yeah, so again, I think, cash flow, it's a lower yield market, like it is, like you said, it's appreciated, and generally it's less affordable when you compare it to maybe some of the other markets in Texas. It's still great affordability when you compare it to the gateway cities, which
Hmm.
again, you always kind of want to focus on, hey, rents have really spiked here, but what is the discount to San Francisco? What is the
Oh
discount to,
yeah, for
right?
sure.
But like that is still a big driver for what is
Yeah.
causing people to relocate. So until that gap, is non-existent, you're still going to have some of that, positive
Yeah.
trends working in favor in the market.
So
But,
what can you
you
get?
can,
What can you get in Austin right now? Like, what price point would you be buying at? Would you be buying a $300,000 house or?
yeah, I mean, it would be kind of probably in that 350 to 400 range is what I would try to kind of focus on. It's an area with Texas generally has higher property taxes,
Hmm.
relative to, a lot of other markets we look at. So, when you look at your cash flows, we're very conservative with how we're underwriting taxes, factoring reassessments, not just looking at what was it historically, because even in states like Texas where it's non-disclosure, counties still find out what houses sold for on the street, and you can see kind of some significant changes in your assessed values. But we factor that into the NOIs, and when you're looking at cash flows, I think you still have opportunities to kind of buy in that
Hmm.
low to mid fours for good locations and areas that I think are still very
Yeah.
in demand with potential residents and investors over the long term. But
Okay.
but yes, I think those everything you mentioned, I definitely agree. And I think the last part I just want to kind of stress there is, and this is for myself as well, like for me, it's very important to kind of diversify, right? And I think, even what I've seen historically, and even Austin, for example, over the last decade, there were years where Austin is best in the country for growth. And, what that would mean is there's some more supply coming, there's more deliveries, and you see, rent growth stagnate for a year, for 18 months,
Yeah.
and then it'll
Yeah.
be top of the market again. So what can you do about that? It's being diversified,
Yeah. Yeah. Not all
actually
eggs in one basket. Yeah.
having exposure to another market, because that year when Austin was flat year over year on rents, Orlando was booming,
Hmm.
right? So if you had an Orlando property and an Austin property,
Yeah. It
those
offsets.
years it offsets, and you're kind of keeping that growth consistent, and seeing an overall portfolio growing. So I
Yeah.
think that's also very important, and try to make sure you kind of
Yeah.
get that diversification, whether it's markets, even submarkets within a certain location, and then even the profile of the homes, right? Not
Yeah.
not everything needs to be shiny and new. Sometimes it's also good to kind of chase some of those higher yielding assets, and it's a personal kind of a
Oh,
bit
for
of it is a
sure.
personal preference of what you're comfortable with.
For sure. And if you paid 450 in Austin, what are you getting for that?
Yeah, yeah. I mean, you're getting. I mean, yeah, like for 450, you're getting into North Austin. Very good schools. You're
Like a
probably
three
looking
bed,
at,
two bath
yeah, yeah, three, potentially even four
with a
bed, two bath.
garage?
Yeah, yeah, you're likely getting garage. I mean, I'm presume for that price, I'd be targeting a 2000s or newer, a
Hmm.
newer property. Again, zone well, whether it's Round Rock or Cedar Park, kind of North Austin. I think you can kind of get opportunities there in
Yeah.
that price point. You can go a little bit lower and look at some other pockets,
Yeah.
which I am considering as well. But again, it's really a risk reward type play, right? Like
Of course, you're
I
gonna get a
probably
little
want to
higher
get into
yield, but you're gonna take the risk too. Yeah.
exactly.
So, not to get off of what we were talking about before, just with the one example. So 450, like what kind of rents would you get on something you're paying that 450? You're getting the garage, you're getting the four bed, two bath. What do you think
Yeah,
that's gonna
so
rent
so
for?
so again, something with rents is it varies, right? Like
Yeah.
there's ranges. So, not necessarily I'd have to kind of, pull up a specific deal, but I'm targeting rents, definitely north of, 3,000 in that type of price point.
Hmm.
Again, that can
So
potentially
it could be
push.
like 3,200 or
Yeah,
something
yeah.
like that.
I've
Hmm.
definitely seen deals, even in the $3,500 range there for that type of profile that I've looked at myself.
And would you have
And really, again,
taxes like would taxes be like 10 grand a year on something like that?
again, it will vary county by county, and like, there's school millages, etc., that affect it. I don't necessarily think it pushes up to 10, but probably be a touch lower than that.
Yeah, so even like 8,500 or something.
Yeah, yeah.
And then something like that to insure that on an annual, is that going to be 2 grand a year or something like that?
We have pretty favorable master policy for insurance. So I would say it'd be kind of in that, $1,800 range.
Okay.
And again, it would be dependent on the square
Yeah.
footage, right? Like you might, certain deals might be a bit
Hmm.
smaller. So your insurance costs may be a little bit more
Hmm.
favorable because you're
Right, right.
you're insuring less square footage, but
But something like this, you wouldn't have any utilities. The tenant would pay all the utilities. Uh, you wouldn't have any grass cutting or snow removal, obviously. What would the manager be taking in a typical, like, I know there's a range to that too, but a ballpark percentage that a manager would take on something like that?
yeah, so from a third party management standpoint, what's typical in the market for kind of retail investors is about 10% of rents. So
Okay.
property managers will take 10% of rents. They'll take 1 month on new leasing,
Hmm.
and then anywhere from like a flat couple $100 fee to a week of rents for renewals.
Oh, okay.
Our master agreements are definitely more favorable. That our manager are anywhere from 5 to 8%
Hmm.
of rents, and typically are in the 2 to 3 weeks of leasing fee for placing a new tenant,
Yeah,
and lower obviously for
sure.
renewals. So we definitely realize economies of scale
Yeah,
for our clients there.
because you're bringing so many clients.
Yeah.
That's,
And then you're right,
yeah,
utilities,
yeah.
that's on the tenant. So, that's a little bit different than how you may see it in markets like Ontario.
And a Canadian coming in, like how would they likely finance that? Like, are they going to get 75%, 30-year amortization? Or and what kind of rate ballpark are they in these days?
Yeah, so there's definitely financing options available for Canadians. So I think if you're looking kind of straight mortgage, the product that fits best with investors into single family rentals, which is a bit unique to the US because it's not really something we have here in Canada, are debt service coverage loans, DSCR
Yeah.
loans, which are really kind of investor loans for the single family asset class. It's kind of like a
It's a
commercial, yeah,
commercial
it's like a
approach. Yeah.
commercial loan that you
Hmm.
so it's focused on, what is the investment that we're lending on? Like, what
Yeah.
are the rents? What is going to be the expenses there? Principal, interest, taxes,
Hmm.
insurance. What's the coverage? And they land to, a percentage of price,
Right.
at a certain rate. And you can kind of customize it, right? So
Hmm.
you might want more flexible prepayment. You might want, interest only.
Yeah.
There are partners that can kind of facilitate that, and you're just paying kind of a premium on rates.
Right. I mean, if it were me,
Um,
I'd want the 30-year mortgage that can't change. The rate's locked
Yeah,
in,
yeah, yeah.
and yeah. So I mean, I guess
I think
seventy-five
I think
percent is probably
generally
what you're
speaking, you're
typically going to get.
definitely you're you're definitely right. And that's sorry, apologies. Yeah, that's definitely right. And you're getting that fixed 30-year amortizing loan. You could potentially look to get interest only.
Hmm.
For 10 years, have that be a 40-year
Yeah,
mortgage,
that's the
etc.
way you can make it cash flow in the short run.
Yeah,
Because just with these specific numbers, it's looking like it's a little tough. Like even if you're at 8% and you did get the 3,500 a month for
yeah.
rent, you're still at a slight loss on the cash flow. Unless there's probably some
You
stuff I could play with here a bit, but I ran the management at 8%, just like
Yeah,
an
yeah.
all in
So I mean, I
cost.
think there's a few things there, right? You can take, typically, foreign nationals, they're subject to kind of a 35% down payment. There are definitely,
Oh,
some
okay, so
lenders
you're going to
will
be
go
in
to
for a bit
30,
more, yeah.
yeah, 30 to, 25% down payment. But again, that may come with a little bit of a rate premium. So
Hmm.
typically, we may look on homes like that, just go in on a lower leverage point.
Yeah,
And yes, I mean, having that fixed rate for 30 years is great, but obviously, right now we are in a very high interest rate environment
right,
with
yeah.
expectations that, over the next few years, like, rates will come down. So I think it's important, for us as we discuss with clients to kind
Hmm.
of make sure, hey, we don't have the outlook on what happens, to the T with rates, right? Like no one has that crystal ball. It's driven by macroeconomic policy, et cetera. But you
Right.
want to be prudent and positioned where you can take advantage of, the changes in the
Yeah.
capital market environment. So, having that ability to kind of, prepay and refinance the loan in 3 years' time might be better than and paying a little bit of a premium for that than having it open after 5 years. Because even though these mortgages are, 30-year
Yeah, you can
mortgage,
break
you can
them. Yeah.
actually still,
Yeah.
refinance and break them and put
Yeah,
in new.
exactly. It's so much better for this is like, and I speak to Americans about what Canadians do, and they're just like, that sounds insane. They're like
Yeah.
that's actually crazy. Every 5 years you got a chance to lose your house. All they have to do is just
Yeah.
change. You have no idea what your mortgage payment will be 5 years from now. Like, you know what I
Yeah.
mean? Like that's
Yeah.
it's insane, but that's been normalized in Canada. I love that security that the US
Yeah.
has
Yeah,
with
and
that.
we are seeing with foreign nationals, like again, given kind of where the interest rate environment is, looking to utilize, their liquidity and leverage that they have available to them in Canada to purchase in the US, in essence, kind of all cash, but really it's
Mhm.
finance, whether it's a home equity line of credit, which again, it's
Mhm.
interest only,
So then they can
it's
essentially use
kind of
lower
slightly.
cost debt. Yeah,
Yeah,
slightly
lower
anyway.
cost, both
Yeah.
on, their monthly payments, but also on origination, right? The loans, the DSCR loans will still have a few points being paid to the lender for
Mm.
underwriting, for origination, et cetera, versus, tapping into your HELOC could be, it is more cost effective. So again, we weigh that against kind of,
Yeah.
individual clients' views and preferences, but definitely, actively track and monitor,
Hmm.
that financing component of the investments, because that's definitely a lever you want to
Yeah.
be putting on to maximize returns, which is ultimately what we're focused on.
And like you said, you could still do it with an interest only. I'm a fan of paying down. I like to have my mortgage amortized, want it to be paying down. But you could pick other areas that are higher yielding, but not as AAA kind of neighborhoods.
Yeah,
But it's everybody's
exactly.
appetite, right? You have to
Yeah,
you have to know kind of what your appetite is, and then of course. We're talking hands-off investing here. If you want to get hands-on, you can always go make a deal.
yeah, yeah,
So yeah, it's a buffet out there. It's not a one
yeah.
size fits all.
Yeah, and I think that's our focus, is like making it easy for people to
Mhm.
diversify and build a
Yeah.
portfolio. And over time,
Yeah.
that's kind of what we're focused on helping our clients achieve.
Yeah. Yeah. And when I ran the numbers with Andrew, we came up with a scenario where it'd be a couple $100 of cash flow and like
Yeah.
after a refi, it'd be like 17% return on investment or getting close to
It, it,
20. Yeah.
exactly, right. So
Yeah.
that's how kind of you
Yeah.
that's how we're looking at it, and we definitely see those type of opportunities. But again, it
Yeah.
not necessarily won't be in Austin. Hey,
Yeah. No, hey, I like,
yeah,
I'm
and
glad
that's
we
and that's
fleshed that
fine. If
out.
everyone
Yeah.
has
Yeah.
kind of a different presence, I think that's why it's important to kind of
Yeah.
balance,
Yeah.
what you have exposure to.
And you pointed it out, like Texas is a high tax state. So yeah, if you really like Texas and you really want to be there, that's awesome. But it's great to have some diversity. Great to be in some states that aren't so high tax.
I look, my personal view on the high tax part of Texas is, as long as you're underwriting for it, right? Like if you're
Yeah.
underwriting, you know what you're
Yep.
buying into it. Like that's
Yep.
why cap rate is such an important metric in real estate when you look at things, is because at the end of the day, that factors in,
Mm-hmm.
what your NOI is.
Yeah.
And, the big risk when it comes to taxes for me in markets like Texas, and we saw a lot of, investors get into Dallas over the last couple of years and really get burned on that, is when you're buying taxes, looking at, what has it been historically,
Mm-hmm.
right? And you might be buying something for, $350,000 that was assessed last year at
So you got to
$200,000.
know where it's assessed.
So if you're,
Yeah.
yeah, so looking at last year's taxes is not enough,
Yeah.
right? Because if you're factoring that in and even applying, like, a growth factor to it, what you might see is 25% growth in taxes year over year once you've purchased it, because
Yeah. Because they're going to look at the
market
new value.
values
Yeah.
and the state is good. But if you've underwritten the deal based on, 85 or 90% of the purchase price you're paying, mimicking what the county will likely kind of do based on, what they've done historically. And we have, we chat with tax consultants as well. A lot, there's firms that kind of handle that stuff
For
for
sure. Yeah.
big institutions. And if you underwrite that when you're pricing the deal and running your numbers, that high tax environment is less, it doesn't really affect you, like versus like an Atlanta or even a Birmingham, which might have the lowest taxes, right? It's all a
Right.
matter of what is that entry point that you're getting into at? And obviously the buy is very key when you're doing
Yeah,
real
you just
estate.
got to be informed. I agree
Yeah.
with that completely. So, Dimitri, I'll give you a chance to give your spiel. Just if like what you can offer people. I know we've flushed a lot of that out, but if you want to just let them know, kind of if they're looking for X, where they reach you. And I think
Um,
that we can throw a link below the video
Yeah,
that
yeah. If you can
they
throw a
can
link
use.
below, that'd be easiest.
Okay.
If if any listeners sign up, the way that the process will work is you'll be prompted to book a call. It will either be with Andrew, Kim, not Andrew Hines, Andrew Kim, my co-founder, or myself to kind of give a more thorough overview of who we are and share and what we're building. And we'll kind of take you from there and figuring out, how we can help in when it comes to the US real estate investing and the journey, especially for Canadian listeners, and really streamlining everything from entity formations, tax structures, to sourcing the deal, to lining it up with our financing partners, getting to close, and then taking on the tasks and the oversight of the performance. So we can help, and we want to help kind of along the way and really make it much easier for foreign nationals and out of town investors to diversify their portfolios and get exposure to different market, different trends in the economy, and ultimately build a portfolio of high cash flowing deals that help supplement or replace income from day jobs.
I love the sounds of that.
Yeah.
That's all. Hey, I'm all about the passive, so I love the
Yeah, there,
cash
there,
flow,
there you
and
go.
there's definitely ways to do that in the U.S. So awesome. I think it's pretty cool what you guys do, and I really
Appreciate
appreciate
that.
you coming on the show and just kind of sharing your wisdom, markets you picked, the numbers. That was insightful, and I'm sure it'll give a lot of people a lot of value.
Yeah, awesome. Real
Okay.
appreciate it, Andrew. It's been a pleasure.
Okay. Thanks, Dimitri. Nice to meet you.
Nice to meet you.